Good afternoon, everyone. Welcome to James Cooper Creston's Academies Accounting and Finance Update. My name is Mike Farwell. I'm a partner in James Cooper Creston's Academies team and head of our Charities and Education team. I'm joined today by Senior Manager Darren O'Connor, who works with many academies. We've got a good number of attendees for the webinar, so thank you very much for joining us. The aim is that the webinar will last for approximately half an hour. In terms of questions, you do have the ability on your screens to submit questions, and we'll deal with questions at the end, but you're also very welcome to contact us after the webinar if you have any particular questions relating to your circumstances. We'll be covering 4 key areas during the webinar. We'll be looking at the new Academies Financial Handbook for 2015, looking at the changes and a brief recap on some of the key areas. We'll be looking at the Academies Accounts Direction for 2014/15. This is approximately a 150-page document, and Darren will be telling us why there are 2 documents this year. Thirdly, we'll be considering some of the key issues in preparing the annual accounts that we typically see with academies that we act for. And fourthly, we'll be covering off some other financial matters relating to the annual accounts and audit process. It'd be helpful for us if we just start with a brief poll. It'd be quite helpful for us during the webinar to know how many people on the webinar are 1, considering becoming an academy, 2, an academy preparing accounts for the first time, or 3, an established academy. So it'd be helpful for us if you could just click on the relevant thing on your screen, and I'll give you a few seconds to do that. I imagine we'll see that there's a reasonable spread of people on the call from different sectors. Just give you a few more seconds to do that. Okay, we'll close that now. So the majority of people on the call are established academies, but there are a few people who are also considering becoming academy or dealing with the accounts for the first time. So hopefully you'll all find something useful in the seminar, in the webinar. So in terms of the new Academies Financial Handbook for 2015, it's 50 pages long, so reasonably concise, certainly compared to the Accounts Direction. It covers the accountability framework for academies. It outlines at the beginning some of the changes from the previous handbook, and then there's a complete section covering all the requirements. In terms of the framework for academies, academies are all companies limited by guarantee. So the directors of the academy have statutory duties under the Companies Act 2006, so for example to take reasonable care. They're also charities, so charity law applies and they need to operate in the public interest. And they're also public sector bodies, so they're accountable to Parliament and need to maintain high standards in public life. The funding agreement that all academies have with the EFA requires academies to comply with the Academies Financial Handbook. It's perhaps worth mentioning at this stage that the terms trustees, governors and directors are generally used interchangeably in these documents. So in most cases they are the same people. So perhaps historically have been called called governors, but now maybe called trustees or directors. In summary, the Academy's Financial Handbook outlines the key principles of good financial management and applies to all academies. There has been a period of consultation before the 2015 edition was released. One of the key messages from academies was that they wanted some stability, and I think it's good to see that there aren't so many changes this year. In terms of the 2015 handbook, that applies from the 1st of September 2015, so that came into force earlier this month. The 2014 handbook, which is what your auditors will be looking at when they do the audit in the next few months, applied for the year to the 31st of August 2015. These documents are available on the gov.uk website, and one of our latest slides gives you a link to that. So if we just cover some of the key changes, the EFA said that many of these changes were to do with enhanced government and transparency. There were some situations where there are shadow directors of academies, so these would be individuals who are governing the academy, but perhaps not registered with Companies House as directors. The EFA requires these people to be formally registered with details shown in the account. There's also a requirement that the EFA have indicated that financial notices to improve can be issued where there are governance concerns rather than just financial concerns. What this is doing is emphasising the importance of governance in an academy situation. As far as accounting officers are concerned, the EFA sees those as a key part of accountability, and accounting officers need to take personal responsibility for spending money only for the purposes for which the money was intended. And accounting officers are expected to demonstrate the highest standards of ethical behaviour in their decision making. And there is a report, the Nolan report, which outlines 7 key principles, including such matters as integrity, openness and objectivity. There's a requirement for more disclosure of governance, so governance information, so for example who the governors / directors are, how the academy is set up and how it's run. And the theme which will emerge during the webinar is the question of conflicts of interest, which is a topic of great interest to the EFA. So there is a requirement to keep a register detailing any business interests of governors, and there's also a requirement to note any relationships between trustees or between trustees and members of staff. In terms of other changes, there is a requirement in connection with the value for money statement, which Darren will cover in a few minutes. In terms of management accounting, there's a bit more flexibility to suit academy circumstances, and there are some changes in the requirement for an audit committee. Broadly, in the previous times, the requirement was for academies with income over £10 million to have an audit committee. That's now been increased to £50 million, which I think is quite helpful. Many academies struggle to get the right people on their audit committee, and I think essentially now the requirement is likely to apply just to multi-academy trusts. But it will be interesting to see what academies do who perhaps already set up an audit committee. Another important change is that academies are now able to enter into leases of up to 7 years without EFA approval. Previously the limit was 5 years. So they're the key changes in the handbook. In terms of a brief recap on the handbook as a whole, there are 4 parts to the handbook. Part 1 covers roles and responsibilities. So there's a requirement here to make sure that individuals, either management and trustees, understand their responsibilities, are open and transparent. There's information about the responsibilities of company directors, charity trustees, and it also emphasises the importance of the accounting officer in terms of matters such as value for money and regularity. Part 2 covers the main financial and governance responsibilities which trustees and management need to consider. So the requirement for strong oversight and control, the need to meet regularly, have a finance committee, etc., make plans, and also the need to have more specific controls in terms of managing budgets, schemes of delegation, considering risks. There's also a requirement imposed upon academies to make sure that they have a process to make sure that these controls are actually working. That's the type of work which historically has been called responsible officer work or internal assurance work. Part 3 covers delegated authorities. So this indicates the extent to which academies have freedom to enter into financial transactions on their own account, and also outlines situations where the EFA approval is required, which is often the case to do with particular payments, write-offs and transactions with land and buildings. Connected parties, the EFA is a strong focus here. Any transactions with connected parties must be at cost. That's triggered a lot of debate. And also a requirement to avoid conflicts and manage conflicts of interest. There are some useful appendices at the back of the handbook which detail the freedoms and responsibilities. And the 4th part of the handbook covers audit requirements. So academies are companies, charities, public bodies, should be open to public scrutiny and need to prepare accounts and have an independent audit. There's also a very useful appendix at the back of the handbook which considers the things that academies must do. So that's a very useful thing to read just to make sure that you're doing everything that you need to do. So in summary, you need to understand the handbook, make sure that you keep control of what's happening from a financial perspective, make sure that there are high standards of behaviour relating to financial matters, and make sure that you're accountable and transparent. I'll now hand over to Darren to cover the accounts direction.
Okay, thank you, Mike. So in this part of the webinar, we'll be covering off the Accounts Direction 2015. And in particular, we will look at the changes from the previous version. We'll focus on the governance statement and changes in this area. And we'll have a look at the EFA feedback from their review of the 2014 statutory accounts. And then finally, we'll look at the transition to SORP 2015. It's worth noting at this point, as Mike mentioned, there are two versions of the Accounts Direction this time around. There is the Accounts Direction SORP 2005 and the Accounts Direction SORP 2015. The majority of what I'm going to talk about today will focus on SORP 2005 version. This is because most academies will prepare their accounts under this version this time around. To prepare the accounts under the SORP 2015 version, you would have had to convert post 1st of January 2015. It is worth noting that early adoption is not permitted. So some of the key changes, risk pooling arrangements. For those of you that are not aware, risk pooling arrangement was an arrangement set up a couple of years ago where individual academies could opt in to the EFA risk pooling insurance scheme, whereas instead of taking out insurance by themselves, they would enter the EFA scheme. The cost of this of opting into the risk pooling arrangement was netted off or deducted from your general annual grant, your GAG income. The Accounts Direction this time around has made it clear that you should gross up both your GAG income and your insurance expense in your accounts to ensure that there is an insurance cost within your accounts. Secondly, agency arrangements. So this is any accounting transaction where as a school you do not have complete control over how the funding is spent. An example of this is the 16 to 19 bursary fund, where the funder essentially has the discretion over how the money is spent. The Accounts Direction makes it clear that in this case and similar cases, there should be no income or cost shown within the academy accounts. The only time they would show an accounting transaction is if you were acting as agent, and therefore you would account for the fee. This raises an interesting question for other sources of income, for example, school trips. Are school trips an agency arrangement? Well, it depends on each individual circumstance, but you must have a look at the risks and rewards. And for example, is the school liable to the travel agent or not? So it will come down to a case-by-case basis. Connected charities. Now, a connected charity is any charity set up for really the sole purpose or the main purpose of aiding and helping the school. Related parties have been a hot topic for the EFA for a number of years, and it seems as though they have now clarified the definition of connected charities. Within the Accounts Direction, there is a useful checklist at 8.3, which should help you understand whether there are arrangements in place that would be defined as a connected charity relationship. If so, this should be highlighted to your auditors. The creditor note, and in particular the loan aspect of it, as we know, any loan arrangements need prior approval from the EFA and the Secretary of State. There are some exceptions, such as the Salex loan, which is commonly used for boiler replacements and repairs, where in fact as a school you are allowed to take out such loan arrangements. But the disclosure, there needs to be valid disclosure within the accounts, and this is detailed out in the Accounts Direction. You should disclose payment terms, interest rates, and any security. Trustee remuneration, as we're aware, for a number of years, trustees who receive an income, even if it's in the role as a teacher rather than as a trustee, the remuneration needs to be disclosed within the accounts. The latest Accounts Direction makes it clear that pension contributions should be disclosed, and in fact they should be disclosed separately from other remuneration. Multi-academy trust disclosure. This is an area where EFA have brought some criticism to previous versions of accounts, mainly in the area of inconsistency between each school. Some of the areas they've highlighted is central recharges should be disclosed Even if there are no central recharges, this should be explicitly stated. There should be analysis of income and cost per school. Fund balances should be disclosed per school. If one of the schools is running at a deficit fund balance, this should be noted, and also it should include why and how this will be rectified in the future. Moving on to the governance statement. As we are aware, an academy is a public body, and therefore there is a need to produce a governance statement within your financial statements. The governance statement should include an outline of the structure, the board and committees, attendance at meetings, details of any internal controls, and any findings from reviews that have occurred during the year. There are two new requirements in the governance statement this time around. Firstly, value for money. Previously, this was a separate document that did not form part of the accounts, but under the latest accounts direction, it now forms a couple of paragraphs within your governance statement. The first paragraph is a prescribed statement where essentially the trustees are acknowledging their responsibility to value for money, and then this should be followed up by a number of examples. The guidance from the EFA is that 3 examples would be sufficient. These examples should cover how the school has demonstrated value for money, how they have improved outcomes with the same resources as previously, and any lessons learnt or opportunities for the future. Secondly, governance reviews. This is a new paragraph within your governance statement. This is mandatory for all first-year academies, but is also considered good practice for all academies. This paragraph should include a review of the effectiveness of the board and any lessons learnt. It should also include future reporting. By that we mean what will be covered in future governance reviews, what the remit will be, and how it will be reported. Moving on to feedback from the EFA. We've already discussed multi-academy trust or MAT disclosures and the areas where EFA have recommended improvement. Given that there is a general trend towards multi-academy trusts, I would imagine that the EFA will continue to focus on the MAT disclosures in the accounts. Governance statements, as we've just focused on, the criticism in this area have really been that not many schools have moved away from the standard text within the coat-tail. They've been boilerplate, let's say. Schools should expand on their experiences, both good and bad, within their governance statement. Finally, the trustees report. The EFA's comments were broadly around the fact that trustees reports included mixed messages and in some cases were confusing. The reason they put this down to is because they felt the trustees report was produced or put together by a number of different individuals within the school. And one recommendation was that one individual should have control over the trustees report to ensure the style is consistent and the message is consistent throughout. Moving on to SORT 2015. So I've mentioned so far most of what I've covered, if not all, is applicable to SORT 2005 version of the accounts direction. But by next year, so by the accounts 31st of August 2016, all schools will be operating under the SORT 2015 version. There are some changes, mostly in the area of presentation and format. The layout will change, some of the terminology will change, and it should be easier to follow. Holiday pay accrual may affect some schools. This is where you can carry forward holiday. If you have any members of staff who can carry forward holiday beyond the 31st of August, for example, perhaps administration staff, you may end up needing to bring in a liability into the accounts. And key management personnel. The definition and terminology around key management personnel will change as part of SORT 2015, which will probably mean that more of the individuals within a school will fall under key management personnel. This could lead to additional individuals' salary details being disclosed within the accounts. However, this will be clarified in time. That concludes our element on the accounts direction, and we're just going to finish off with our second poll. The question is, do you think What the EFA requires of an academy on financial matters is too detailed, about right, not detailed enough. Given this time round there hasn't been as many changes to the accounts direction, you'll be interested to hear people's responses on that. We've still got a few coming in, and overall it looks as though it's pretty even, but a little bit more way towards too detailed. It's interesting to hear that. Thank you very much. Now back over to Mike to cover off key issues in preparing the annual accounts.
Okay, so we're on the third of our 4 sections now. Darren's covered some of the key points in the accounts direction. So what we're going to do now is just to cover off some of the key issues that we see arising in the preparation of accounts. The first section will cover off new academies. For those of you who've been with academies right from the start and perhaps have dealt with accounts for 3, 4, 5 years, I'm sure much of this will remain a very happy memory from those first set of academy accounts that you prepared. But certainly in the first year, there are some very unfamiliar things that need to be dealt with. Firstly, the accounts are unusual. People are seeing them for the first time. And secondly, there are some unusual transactions which appear just in year 1. So in terms of any surplus, hopefully that you require from the local authority in the first year, that's treated as income. If you're unfortunate enough to acquire a deficit, that would be treated as a cost. There are often issues around land and buildings, typically in situations where a local authority is involved. Usually there's a 125-year lease. These are, for accounting purposes, treated as an asset of the academy and are included in the accounts in the first year at the value of the land and buildings. This means that you have a rather unusual set of accounts in the first year because often you have a very high level of income representing the value of the land and buildings. For some large secondary schools, this can be as much as £20 million or even more. And the buildings element of the land and buildings is depreciated and the cost is spread over a number of years, often 50 years. Any other fixed assets that you inherit from the local authority need to be assessed. So, for example, IT equipment and furniture, etc. The value needs to be assessed, and that is also recorded as income in the accounts. And you need to have a register of what those assets are. Pension schemes are a very topical subject at all times in schools. In the first year as an academy, there are some particular requirements in the context of the local government pension scheme where historically there has been an increasing deficit. That deficit needs to be taken on in the balance sheet of the academy and treated as an expenditure. Because of the nature of the teachers' pension scheme, no deficit needs to be recorded on the balance sheet of the academy, although there are lots of disclosures in the notes to the accounts to do with the teachers' pension scheme. There are also some additional disclosures in the first year. In terms of the first period of your accounts, for those of you who are preparing accounts for the first time or considering conversion, the first period can't be longer than 18 months. So typically, if you were incorporated pre-28 February 2015, you would need to be preparing a short period of accounts to the 31st of August 2015. 31st of August, of course, being the year-end date for all academies. If we move on to some of the more regular things that we see in academies, you'll see that a number of things referred to here that we've touched on already. People are often surprised by the length of the accounts. Often the accounts might be 25, 30, 35, 40 pages long, so it's very detailed. Lots of disclosures, very prescriptive disclosures detailed in the accounts direction. The trustees' report is often long and detailed as well. As Darren will cover, this needs to be planned ahead, and as well as all the statutory requirements that need to be in that report, you need to consider whether there's any key messages that you want to get across to people reading the accounts. There are some unusual rules to do with income and grant accounting, and occasionally this throws out the odd quirk. So sometimes, for example, income might appear in a different period to the expenditure to which it relates, which often throws out some unusual results. The pension deficits are always a big issue, so these make a big hole often in the academy balance sheet. But I think the point to note here, there isn't any requirement to pay cash immediately to fund that deficit. Essentially, the plan is that the deficit will be covered by increased pension contributions over a long period of time. There are requirements to disclose related party transactions, so any transactions with trustees need to be disclosed in the accounts. The auditors will often need to consider regularity, so this is making sure that monies have only been used for intended purposes. There are also some specific disclosures relating to multi-academy trusts. Although often when you see a set of multi-academy trusts, they don't look remarkably different to a single standalone academy, so the extra disclosures are not huge. There's also the key question, of course, about who prepares the accounts. Our experience of working with academy clients is that they nearly always ask us to prepare the accounts. We have specialist software to do that, and we're experienced at doing them. But some academies may feel the inclination or have the right experience on board to prepare the accounts themselves. In terms of some feedback from the EFA, this is based upon a review of the 13-14 results accounts. There were 2,700 sets of academy accounts received that year. 92% of those accounts were filed with the EFA by the 31st of December deadline. I'm pleased to say that James Cooper Creston maintains its record of 100% compliance with this deadline. In terms of the audit reports in those accounts, in terms of audit reports where the auditors felt the need to qualify or issue a non-standard audit report in those accounts, only 3% of accounts were qualified. The types of reasons for these qualifications, if there was no disclosure of trustee salary, so relating, for example, to staff trustees. Sometimes there are issues to do with land and buildings. Occasionally there are situations where there's inadequate pension information. And sometimes there are information issues to do with the first year of academy and the various transfers in. I think there were also one or two situations where auditors have made reference to doubts about the ability of the academy to continue operating into the future, perhaps in situations where there are falling school rolls and pressures on finance. Approximately 5% of regularity reports, so this is the second report the auditors produced, were qualified. Often these related to related party transactions, lack of checking, absence of an audit committee, unapproved statements, etc. And then finally, in terms of feedback from the EFA management letters, so these are the letters that your auditors will send you at the end of the audit, and these are also sent on to the EFA. In terms of the number of points that were raised, some academies had no management letter points raised, and remarkably one academy had 135 management letter points. So I certainly wouldn't like to be a school business manager on the receiving end of 135 management letter points. But the average is around about 5 points for academies. I think typically we see that in the first year of conversion that the number is often higher than that, but hopefully as the systems improve and get sorted out, the number drops. I'll now hand back to Darren, who's just going to cover a few points relating to the year-end accounts and audit process.
Okay, so given we're now heading towards the end of September and into October, most schools will be preparing for their audit visit and for their audited accounts. Planning well in advance is obviously key. Booking in meetings, both in terms of trustee, governor meetings, where the accounts will be signed, and then working your way back to ensure that there is enough time to clear audit issues with your auditors. Audit deliverables and audit information is crucial. It allows you to plan in advance of the audit, and it allows the audit to be efficient and effective and run smoothly. Trustees reports, we've touched on a couple of occasions today, but getting started with the bare bones or even more than that as soon as possible is definitely the key. There is no need to wait until after your audit fieldwork session to then actually prepare the documents. Submission requirements, the requirements have changed, and now all accounts and management letters need to be submitted via the document exchange. Now, there are login details that each school need, and as such our advice is not to wait to the last minute to request this information, and there is a cover form that goes with the accounts and the management letter. One of the questions last year, and I am sure it will be a question again this year, is whether your accounts are qualified or unqualified. A lot of academies answered this incorrectly last year. If you are unsure, please check with your auditors. Moving on, deadlines. Given we're tight on time, I won't go through these deadlines line by line, but as you can see, it's all listed out for the audit period that we're about to go through. Now I'll pass back to Mike.
So we've had a couple of questions that have come in during the webinar. Someone's asked, what are the options for checking that our internal controls are working? Well, typically schools, academy schools can use a number of different ways of dealing with this. Sometimes they ask their external auditors to carry out a program of work to deal with the operation of the controls. Sometimes there may be somebody internally with the relevant experience who can carry out that work. Or there's a few situations where other schools, where academies enter into arrangements with other schools where they review the other academy and the other academy reviews them. Sometimes if people have got the right experience, that can work quite well. So there's a number of options. The second question that we've had in is, do we have to prepare monthly management accounts? Interestingly, in the new Academies Financial Handbook, it doesn't refer now to preparing monthly management accounts, but there is a requirement to monitor budgets on a monthly basis. So essentially that really does mean I think you still have to prepare management accounts on a monthly basis. It's interesting to know how that compares with the independent school sector, where there aren't the same statutory requirements, but the majority of independent schools prepare their accounts on a termly basis. So it will be interesting to see over a period of time whether the EFA might consider that producing accounts 3 times a year would be an adequate way of dealing with this requirement. So there are the questions that we've had in. You're very welcome to send us through a contact Darren or myself with any further questions. You'll see our contact details on that final slide. We've also detailed on that slide some useful links to the Financial Handbook and the Accounts Direction. Finally, I'd just like to thank you very much for joining us on this webinar, and I hope you enjoy the rest of your day. Thanks very much.
Thank you.